Have you ever lent money to a family member only to feel that twinge of regret later? Well, you're not alone. A shocking 57% of people who lend to relatives report negative consequences. Today, we're diving into the hidden risk of family loans that could cost you more than just cash. It's time we talk about that elephant in the room, lending money to family. It's a minefield of emotions and financial pitfalls that can turn your next family dinner into a scene from a soap opera. Buckle up as we unpack this complex issue. That's why today I'll take you to lending money to family. Here's the hidden risk. If you're new to the channel, hit that subscribe button and our notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the Thrive Wise love to help more people thrive wisely. Now, let's begin. Let's face it, when Cousin Joe asks for a small loan to start his artisanal pickle business, it's hard to say no. But this seemingly simple act can unleash a Pandora's box of challenges. First up, there's the relationship strain. That $5,000 you lent to your sister, it's now the uninvited guest at every family gathering. You're constantly wondering, will she bring it up or should I? The awkwardness is palpable. Then there's the unspoken expectations. You might think it's just a loan, but Aunt Martha sees it as an investment in her cat cafe dreams. Suddenly, you're an unwitting business partner in a venture you never signed up for. And let's not forget about the ripple effect. Word gets out that you're the family ATM, and before you know it, everyone from your second cousin twice removed to your great uncle's dog walker is knocking on your door for a quote-unquote temporary financial boost. And here's the kicker. The blurred lines between generosity and enabling. Are you really helping Uncle Bob by funding his 17th get-rich-quick scheme? Or just postponing his reality check? These challenges can turn family dynamics upside down, leaving you questioning every interaction and dreading family reunions. So why don't we take a deeper dive into this family loan quagmire? It's basically like opening Pandora's box, except instead of unleashing evil spirits, you're releasing a swarm of financial and emotional complications. Buckle up because we're about to explore the hidden risks that turn family loans into the plot of a Shakespearean tragedy, minus the cool costumes. Starting off with number 1, the handshake deal trap. Picture this. You're at a family barbecue, and Uncle Fred has had a few too many light beers, and suddenly he's asking you for a small loan to fix his vintage Mustang. You agree with a handshake, but hey, it's family, right? Wrong. This is the handshake deal trap. Without a formal agreement, you've just entered the Wild West of family finances. No interest rates, no repayment schedules, no collateral. It's like playing Monopoly without the board. Chaos ensues, and someone always ends up flipping the table. So here's a fun fact for you. According to a survey by Bankrate, 60% of people who lend money to friends or family don't use any form of written agreement. That's a lot of financial Russian roulette. Number 2, the bank of mom and dad syndrome. Remember when your parents were just parents? Well, congratulations! By lending money, you've now transformed into the bank of whoever borrowed money from you. It's like being promoted to CEO, except your new job comes with 0 perks and 100% chance of awkward Thanksgiving dinners. This role reversal can wreak havoc on family dynamics. Suddenly, you're not just a sibling or a child anymore. You're a creditor. And let me tell you, can I borrow your sweater hits differently when it's coming from someone who owes you $5 grand. Number 3, the it's just business myth. Mixing family and money is like mixing tequila and decisions. It's rarely ending well. You might think you can separate your personal relationships from financial transactions, but that's about as likely as your cat learning to file your taxes. When you lend money to family, every interaction becomes a complex cocktail of love, obligation, and financial anxiety. Did Cousin Sarah just invite you to her destination wedding just because she loves you, or because she's hoping you'll forget about that loan? Number 4, the ripple effect. Lending money to one family member is like throwing a pebble into a pond. The ripples spread far and wide, and before you know it, you're the family's unofficial credit union. Imagine this scenario. You lend money to your brother, and your sister finds out. Suddenly, she's wondering why you never offered to help her with her student loans. Your parents are now concerned that you're playing favorites. And your grandma? Well, she's just confused about why you haven't bought her a new TV yet. Number 5. The Enabler's Dilemma. Sometimes saying no to a loan request is the kindest thing you can do. It's like refusing to give car keys to your drunk friend. Sure, they might be mad at you now, but you're potentially saving them from a much bigger disaster. By constantly bailing out a financially irresponsible family member, you might just be enabling destructive behavior. It's the financial equivalent of giving an alcoholic just one more drink. Number 6. The assumption. When it comes to family loans, everyone's an expert in mind reading. Or so they think. Your cousin assumes you won't charge interest because, well, you're family. You assume they'll pay you back as soon as they get their next paycheck. These unspoken assumptions are like the invisible tripwires in your relationship. One wrong move and boom, you're tumbling into a pit of resentment and misunderstanding. Number 7. The "but you're rich" fallacy. If you're doing well financially, family members might see you as a Scrooge McDuck, swimming in a vault of gold coins. They don't see the years of hard work, the careful budgeting, or the sacrifices you've made. This perception gap can lead to unrealistic expectations and feelings of entitlement. Suddenly, your decision to save for retirement instead of funding your niece's dream of becoming a professional unicyclist makes you the villain in the family drama. Number 8. The repayment roller coaster. Collecting on a family loan can be more unpredictable than a game of Jumanji. One month, payments are flowing smoothly. The next, your debtor is dodging your calls like Neo dodges bullets in the Matrix. This inconsistency turns you into an unwilling financial detective. Is Aunt Linda really just a bit short this month, or did she just post pictures of her Bahamas vacation on Instagram? Number 9. The tax man comes. Here's a fun surprise. The IRS loves family drama too. If you're lending significant amounts or charging interest, Uncle Sam might want a piece of that action. Suddenly, your act of kindness has turned into a tax nightmare. It's like organizing a bake sale for charity and ending up with a health code violation. In conclusion, lending money to family is like trying to perform surgery on yourself. It seems like a good idea at first, but it's complicated, messy, and likely to end in tears. Remember, 67% of people who lend money to family report never seeing that money again. So next time a relative asks for a loan, maybe direct them to a bank instead. After all, bankers are much better equipped to handle financial disappointments, and they're less likely to uninvite you from Christmas dinner. Since you're still here, how about I give you a little bonus? Let's talk about the cautionary tale that will make your jaw drop. Enter William Randolph Hearst, the inspiration behind Citizen Kane and once one of the wealthiest men in America. In the 1930s, at the height of his empire, Hearst lent millions to his family members, including his 5 sons. He believed he was setting them up for success. Instead, he inadvertently engineered his own financial downfall. As the Great Depression hit, Hearst's media empire began to crumble. But here's the kicker. He couldn't call in those family loans. His sons, accustomed to lavish lifestyles, couldn't or wouldn't repay. The emotional toll was devastating. Family dinners turned into financial interrogations. Trust evaporated faster than water in the Sahara, and Hearst's relationship with his sons turned sour, creating rifts that lasted generations. By 1937, Hearst was $126 million in debt. That's over $2 billion in today's money. He lost control of his company and was forced to sell off priceless art collections and properties. Hearst's story is a stark reminder. Even the mightiest can fall when family and finances mix. It's not just about the money. It's about the irreparable damage to relationships that can haunt families for years to come. While helping family is admirable, it's crucial to navigate these waters carefully. Set clear terms, consider alternatives to direct loans, and always prioritize open communication. Remember, protecting your financial health and family relationships isn't selfish. It's essential for long-term family harmony. Also, what's the craziest family loan story you've ever heard or experienced? Did it end in tears or unexpected triumph? Let's swap stories in the comments below. And remember, sometimes the best family financial advice is learning from each other's mistakes. And while that's basically lending money to family, here's the hidden risk. And thank you guys so much for watching today's video. And hey, it seems that YouTube thinks that the next video can completely transform your financial situation. Watch it to find out whether they're correct. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.